Everyone's watching interest rate, but the real risk, banks are quietly pulling funding on the deals. Let me ask you this. What if the next big mortgage shock in Canada doesn't come from the rate hike, but from your bank just saying, no, not on the news, not with any warning, just funding, gone. Imagine walking into your bank thinking you are all set to close on a house, renew your mortgage, or tap into that HELOC, and they tell you, sorry, we're not comfortable with this deal anymore. And you think, wait, what? I'm pre-approved. Yeah, that's the illusion. Because in 2025, as a Canadian homeowner, the danger isn't always what the Bank of Canada says. It's what your bank quietly stops doing. They don't ring alarm bells. They just pull credit back. No press release, no viral headline, just cold clinical credit tightening. And regular people stuck in the middle. So in this video, we are unpacking the real threat to Ontario homebuyers. What happens when lenders start quietly saying no? Why your HELOC might get frozen? Why builders financing might collapse? Why your mortgage renewal could come with an unexpected surprise? No fear mongering, just real facts, real Canadian data, real stories, and the steps you can take now to stay ahead of it. Well, this isn't just a theory. If you are an Ontario homeowner with a mortgage renewal coming up, a buyer closing on a pre-construction home, or someone relies on their HELOC for emergency backup, then this matters a lot more than where the Bank of Canada sets its policy rate next month. Because when lenders tighten, it's not loud, it's silent, and it hits the middle class the hardest. Your deal doesn't get headlines, it just falls through. Your HELOC doesn't make a noise when it gets frozen. You just can't access that anymore. A builder doesn't post about their financing getting yanked. They just delay the construction or cancel the units. And you are stuck because you didn't see it coming. So yeah, if you live in Ontario and you've got a mortgage, this video isn't just for you, it's about you. Here's where most Canadians go wrong. They think pre-approval means they're set, that their builder's lender commitment from way back from 2021 is solid, that their HELOC is permanent. Let me break the news. Pre-approval is not a guarantee. Lenders can and often do pull back at the final review. Appraisal comes in low, risk profile changes, home equity dips, boom, funding pause. And HELOCs, totally revocable. Your bank has the right to freeze that credit line if your property value drops or if the market risk shifts. You won't get a call, you'll just log into one day and it's gone. This is happening right now in Ontario, quietly, case by case. Builders are getting dropped. Homeowners blindsided. Pre-approvals are turning into hard decline. Let's dig into the numbers. And let's anchor this with some real Canadian data. CMHC's 2024 mortgage report shows delinquency rates ticked up to 0.2% by Q3, rising from 0.14. Doesn't sound like much? Think again. In Toronto, it doubled up to 0.16, the highest since 2025. That's not a collapse, but it's a clear trend. More households are missing payments. More risk for lenders. OSFI, that's Canada's banking regulator, reports that about 76% of all mortgages set to renew by the end of 2026. Translation, most Canadians are about to face higher mortgage payment. And the Bank of Canada's 2025 Financial Stability Report estimates that 60% of the mortgage renewing in 2025 to 2026 will see a payment increase, even if the rate drops slightly. Even if people pass the stress test in 2021, they are about to feel it. So what are the banks doing? They're getting cautious. Quietly. They're not chasing volume, they're tightening credit. Which means you have to be sharper, earlier, and more proactive. Let me show you how this plays out. Let's dig into an example. In 2021, an Ontario home buyer bought a pre-construction condo for, let's say, $800,000. Fast forward to 2025, it's now appraised at $700,000. That's $100,000 shortfall. The lender will only fund based on the current value, not what you agreed in 2021. So you either come up with the difference in cash or lose your deposit and that unit. That's brutal. And it's happening now. Let's take a look at another example. Let's say you have a HELOC with 150K limit. You're not using it, but you feel safe knowing it's there. Then your home value dips. Your lender does an internal LTV review. Next day, that HELOC frozen. Access gone. Emergency plan gone with it. You didn't do anything wrong. The lender just decided to reduce the exposure. These aren't edge cases. These are playing out across the province. Let's talk about a couple of real stories. A couple in Vaughan got pre-approved in early 2023. They had a 20% down payment, stable job, a solid bank relationship. They were very confident. Everything looked good. Then the appraisal came in low. Suddenly the lender backed off. The pre-approval didn't mean much. They couldn't get alternative funding in time. They lost the deal. Deposit gone. That's devastating, especially when they followed the rules. Let's take a look at another story. A developer in GTA was relying on a big 2021 lender commitment to fund their phase. But in 2025, that same lender pulled out, citing valuation changes and market absorption risk. Result? The project stalled, trades paused, buyers got anxious. This is the credit cycle turning, and it doesn't come with warning bells. If you are in one of these camps, here's what to do now. For upcoming renewals, call a lender early. Don't wait till renewal. Ask about payment shock scenarios. Run a 1 to 2% rate increase simulation. Can you handle it? If the appraisal might be low, ask your lender if they will top it up for the shortfall. Consider a second mortgage or a private bridge mortgage. Negotiate with your builder. If you're buying pre-construction, include a financing contingency. Check your builder's lender roster. Do not assume all equity is equal to safe closing. If you use a HELOC, know your current LTV. Ask your lender how they assess the risk. Consider a backup liquidity. I know what you're gonna say, but I'm pre-approved. Cool. That's not binding. Until appraisal is done, underwriting is done, and they give you a green light, you're not fully approved. Should I just wait for the prices to crash? Waiting isn't a strategy. It's just a risk with no control. Prices might dip, but funding might tighten faster. Then what? The best move is to prepare, not pause. Because in a tightening credit cycle, those who plan ahead do not get squeezed. So here's what you should do. Check your current home value versus the outstanding mortgage. Run a renewal simulation with 1 to 2% higher rate. Ask your lender what happens if the appraisal drops by 10 to 20%. If you're buying, include a financing contingency. If you are holding HELOC, understand freeze triggers. Knowing isn't optional in this market. It's your best protection. Still unsure how your lender might behave? We get it. AGP Mortgage offers strategic clarity without the pressure. We have helped Ontario families navigate this kind of lender retreat before, and we are doing it every day in 2025. If you want someone to walk through your renewal, your closing, or your HELOC options, no pitch, no panic, book a strategy call. We'll lay out the real number, your real risk, and what your lender might not be telling you. The next move is yours.